Hello traders, welcome back to the channel. In today's video, I'll be showing you the easiest top-down analysis for synthetic indices. So over the week and for the past month, I've been trading synthetic indices because the month of August is usually not a perfect month for currencies, and if you have been trading currencies, you can also attest to that. Currencies have not been very perfect, so I decided to be trading synthetic indices, and I've made a lot of positive trades with synthetic indices. I have some of the results right here. I'll display them right now on my screen. So these are some of the trades I actually screenshotted. Very perfect one. I want to show you the simplest and easiest top-down analysis to do on synthetic indices. I normally trade step index and volatility indices. For those of you who are trading synthetic indices, this video is going to be absolutely amazing. I use deriv.com for the trading activities, and I will be glad to show you everything in detail right here. So looking at what we have right here, I usually use the daily time frame, the 4-hour time frame, and then I drop down to 15-minute time frame and sometimes even to 5-minute time frame. All right, so let me go into explaining everything in detail for you. So the first thing you need to know about top-down analysis, it is simply your ability to look at price action and be able to break it down into lower time frame. All right, what you see happening on this particular chart from the higher time frame, if you are able to reduce it into the lower time frame and have access to same data that can give you a profitable trade. That's simply what top-down analysis does to you. We drop from a higher time frame to a lower time frame and still execute trades with comfort, and the trade goes in our direction. So what we have here is, from the look of eyes, is a bearish bias from the daily time frame. So what do we do once we're able to establish that we have a bearish bias? There are three components to every top-down analysis: where price is, where it is going to, and how price will reach that place. That's simply what top-down analysis helps you to do. So we look at price currently. The most recent data right here is what we look at for. You have no business looking at what is happening here. This is a whole lot of data for synthetic indices. So this is what is happening here. Now, from the most recent price action, I discovered that we are still in a bearish market. You can use this place as your shift in market structure, or you can even consider this place, depending on how you want to see it. All right, but I want to consider this place to be my shift in market structure because I don't want to get too much of confusion. So the next thing to do, it's pretty much easy. You look at what has happened from here, this swing high to this swing low. Always make sure that you extract all the detail that price has given you. Okay, so if I pick my Fibonacci tool and put it right here, from here to the last area, of this price movement, so I will discover that price is still at discount. And ideally, if we are in a bearish market, what we do is to go bearish. But now this is a daily time frame. This is a daily time frame, and what I'm seeing right here is a whole lot of data. And I want to see retracement coming into this. Now I will start to look out for my point of interest because price will obviously be going to premium area. Remember, I told you where price is, where it is going to, and how it is going to go. So these are the elements of your top-down analysis. So looking at this, I will start knowing that price will give me a retracement when I have at least 3 consecutive candles that closes above the previous candles. This is what I mean. Can you see this area? Price coming back, and we took out this one, we took out this 2. Okay, so this candle closed above here, this one closed above here with the body. So I can say that price is trying to retrace back to come to a premium area. What is price going to come to do? To look out for an institutional reference point. An institutional reference point. So we will now go to our premium area and look for those institutional reference point. We have an order block right here. They are all in your premium area above the 50% level of that Fibonacci tool. If you pick your fib levels from here to here, right there, anything above the 50% is called premium. Anything below it is called discount. So that is what you need. So we have this order block, and close to that order block there is a fair value gap right there. So if price is coming, we are expecting price to come back to this area, or we can even see another level up here, the extreme situation now, up there at that level. So if price did not react from here, it may probably react from here, because above here is liquidity. So this is daily time frame. How long will it take for price to come to this area is what we want to do. So we will be counter trading, and that was exactly what I did. I counter traded, and I wanted to see price come to this area. So I decided to drop down to the 4-hour time frame, because that's the immediate time frame after this that can give me a more detailed breakdown of this price action. So this is your 4-hour time frame now. Remember, now you will have access to refine your entire information right here. So these are the information we have right here. So in the 4-hour time frame, we will look out for where price shifted structure before showing willingness to go that upside. So in this regard, I will consider this area to be a shift in market structure for me. This is a lower high, this is a lower low. A lower low, and I consider this to be a lower high. If price closes above this guy, this is a shift in market structure for me. So what else do I look out for? This one doesn't have option for replay, so I may not be able to replay everything right here. So what I look out for, if price is pushing outside this, it will come back to where institutional reference point and tell you that I want to go up. So we have this small order block right here. Okay, we have that small order block. So if we are measuring from here to this top right there, to this area, from here to here, this order block is at discount, because in the 4-hour time frame we will be looking for opportunity to go bullish. You will not be trading in the daily time frame. So this is why I'm looking at this in this regard. So this bullish order block is important. As small as it is, I consider it to be an order block. Price can decide to react from there, or this particular fair value gap. This fair value gap. And anytime you see a very big fair value gap, know that price will obviously look out for the 50% of that fair value gap. And the 50% is here, right at this point. Okay, so in the 4-hour time frame, I can easily wait for price to come back, and then I can take the buy, or I can even refine my entries by going to the 1-hour time frame. And this is what top-down analysis gives you, to get the best kind of entry with the smallest amount of risks. All right, so this is it. In the 1-hour time frame, you have a better price action for you right here. So in the 1-hour time frame, you have a very good price action right here. Okay, let me take out some of these so you can see it. I took these trades that I'm showing you. I'm not just saying it. You saw all those trades I shared with you in the videos. They are some of the trades I took. So what I will be doing is to go bullish. I don't want to sell in this regard, since I know that the daily time frame is bearish and retracement is coming in. It will take time to reach for that particular institutional reference point. If we bring it this like this, price is targeting this place, but the time that it will take to reach this place, it will take a long time. So we want to go bullish. So we are bullish for now. So we look at this. So look at what happened right here. Very perfect price action. I saw this in the 1-hour time frame. I saw this break of structure in the upper side right here, right? I saw that break of structure, and I decided to do this from here to here. All right, I actually started from here. I started from here, this particular place. I saw price came here from your premium. I don't want to buy at premium, because I want to see price come to a discount area. Discount area is important. Please get this correctly. Discount area. It is important. So I will put my line right here. My discount area is right below the 50% area. So price came here. I wasn't so into it. It kept on coming, kept on coming, kept on coming. So when I saw price came below here, this area, discount, I knew that price is trying to do something that will help me out. So that was when I dropped down to the lower time frame than this to get an entry. I want to see that price reach this area. This is implied fair value gap. It touched that implied fair value gap. Implied fair value gap is simply something that ICT thought this is it. If you see this kind of price action, we don't have a fair value gap here because this one and this one have traded through each other. So you will measure 50% of this week, 50% of this, and put your line there, right here. 50% of that, and then 50% of the other week. And that is your implied fair value gap. Your implied fair value gap is right somewhere around there. All right, so this video is taking long. For those of you trading synthetic indices, make sure you watch this video because this is going to help you a lot. This is going to help you. So this is your implied fair value gap. So if you don't know this, you will not know that price is trying to reach out to that. And this implied fair value gap is actually at a discount area. Discount area. All right. Is this a retracement? It is a retracement. We saw price closing below all this one, 1, 2, 3. All these ones I consider it to be a retracement. That's why I consider from here to here to be where price can come to. All right, so we look at this, and then here I took the first trade right here. So when I saw this happened from the 1 hour, I decided to go into the 15-minute, and I wanted to see a shift in market structure as price reached this place. Then I will take the trade and target this opposing liquidity just above here. All right, this is step index. I drop down to the 15-minute, and then this is the 15-minute time frame. Let me go to that particular place. Sorry, I don't have the option to replay right here. So this is it. Very perfect one. Exactly what I did. What I did was here. So when price came here, remember, as price is coming down, it's going to be bearish, and we are supposed to be bullish. Lower low, lower high. Did not create any lower low, lower high, lower low, lower high, and price touched that area. So I was waiting for price to shift structure, lower high. So this lower high became my strongest point of reference. This place, strongest point of reference, this particular place. All right. So price came here, and I was expecting price to push above it since we reached that institutional reference point I call implied fair value gap. Price just bounced from here, and I was seeing price hit this fair value gap right here. Can you see this fair value gap? If you are looking at this while I was watching it, you will see this glitch, and then all of a sudden price shifted structure. Now what do we have? We have a bullish bias from the 4-hour time frame, 1 hour time frame, and we have a bullish bias even in the 15 minutes. Since we have shifted structure, we are planning to go up, and all I did was to wait for price to come to this area. Do not play with your order block when it comes to trading with synthetic. Order block is so powerful, and fair value gaps are also powerful, including that implied fair value gap. Anytime you see them, don't ignore them. They are important. All right. So that was what happened, and price came. I entered the trade right around here. I think, if I could recall, around somewhere around there. And my stop loss was just below here. And I was confident that this trade is going to go in my direction. And the trade actually went in my direction. This one. It went in my direction. It came back again. I did the same thing around here. It came to this area. I think I took profit somewhere above here. So that was how I traded this up until this level. So price shift, anytime you see a shift in market structure after a moving to a particular direction, just know that price is going to go in that direction. It will shift structure like this and come back to retest an order block like this. Once price shifts structures after touching a point of interest, it will come back to an order block or a fair value gap, and that is your entry, guys. All right, you can even refine this up to the lower time frame. If you go to the 5-minute time frame, you will still see the same thing. Sorry guys, I think the thing had a glitch, but the same thing happens even if you go to the 5-minute time frame. You can actually see that as price reached a certain level, you look out for a shift in market structure. As far as price reached that order block or a fair value gap, this is what usually happens. Look at this: lower low, lower high. Did we have a shift in market structure here? No shift in market structure. Look at this one right here. Then price decided to come here and had difficulty. How about this place? Is there a shift in market structure? No, there is no shift in market structure. Why? It is simply because we have not closed with the body of the candle above here. Okay, so you have to take notice of this. How about this place? Now we have a shift in market structure right here. And if you zoom in this, you will discover that this area is reaching out to that all-time institutional reference point from that higher time frame. So this was where the shift in structure happened, right exactly at this point. And that is your entry, guys. Price will always come back to that fair value gap and the order block. Look at it. Price came back exactly to that point. I love trading this particular asset called step index. I think it's one of the assets that I love trading. So price came back. Guys, I was able to trade this. I made almost $1,000 profit for just 3 to 4 days trading this particular asset. So you can go ahead and try it. This same concept. Look for where price is going after shifting structure. Just know that price is going to go to that area. Shifting market structure, price coming back to this area, and boom, price headed to that side. Okay, you can even see from the most recent one here, price here. Shifting structure, where was exactly the shifting structure? Somewhere around here. The shifting structure happened somewhere around here. Shifting structure happened at this exact point, and then price came back to your order block and it headed that side. So look at where price is going to, and then in the lower time frame, all you need is just your shifting structure, and that is where price will start going up. I think this is enough for you to start trading synthetic indices, and make sure you do the top-down analysis with the higher time frame in view. As soon as you reach area of liquidities, you exit. Make sure you do that repeatedly. And if you have any question, guys, let me know in the comments. Thank you guys for watching. See you in another video.